Hello, one thing we always like to do here is get started on time. So welcome to our webinar. Today's subject is mitigating risk in your portfolio. How do we manage this stuff? We'll take a look. Quick introduction. My name is Wesley Walters. I'm the founder and CEO of Asset Preservation Solutions. We just celebrated our 17th anniversary. We are a company committed to really keeping people's money safe. So we want to mitigate risk inside your portfolio. We saw what just happened over the last 3 months, and we'll take a look at that in detail. I'm a member of the Council of Financial Educators. We are committed to helping people understand the financial world. As I bump into a lot of people, they've done a great job saving in their 401k, might have paid their house off, but they don't seem to understand financials very well. So what Coffee does is hold webinars like this or events in businesses and help people understand the ins and outs of finances. Every good webinar has to have a disclaimer. I will wait just a moment and let you read that. Okay. By the way, nothing I say here today can be taken as any kind of recommendation at all. We're not going to talk about products, just strategies. But at the end, you'll see a fact sheet from a particular company. I am not endorsing or suggesting that's a good place for you to put money. We're holding a series of webinars in the Coffee frame of mind, just so people can see the schedule. We're having some at lunch and some right after work. So please join us for those topics that you find interesting. So here's a statement I always like to ask people. Do you agree with this statement? Is it the responsibility of every investor to only take enough risk necessary to accomplish their plan? What I mean by that, and most people don't have any idea how much risk they are taking, is if we can show a plan that doesn't require a lot of risk to accomplish it, do you still want to increase your risks? You might. Wall Street is a bit like a casino at times. So we'll take a look at a box here in just a second. We can help answer that question. But do you agree with this statement? So this is the continuum of risk. If you look way to the far left, you'll see stocks. They have the potential for the most gain. They have the potential for the most loss. Mutual funds, variable annuities, bonds. We're only going to deal with that side of the fulcrum on this particular webinar. I have another one about annuities that you can see on our website. So when you look at your portfolio, how closely does your portfolio move with the indexes, the S&P, the NASDAQ, the Dow, the Russell, etc.? How do the internal portions of your portfolio move with each other? And you'll see a chart on this in one moment. What did your portfolio do when the market just dropped 35%? You just went through this. Yes, there's an amazing comeback going on. I won't comment about market conditions in this webinar, but what did your holdings do? So this is a great starting point to evaluate your tolerance of risk and your view of risk. And I suggest you write down your answers. So if all your money is sitting available to you, how much, what percent would you like to put in each of these boxes? Box number 1 is principal protected. That means it's not going to lose money no matter what happens. The ability to gain is hindered a little bit, but over time you should expect 3 to 6% with this box without having any principal risk. Box number 2 introduces risk, and the risk can be from losing 15% to gaining 10%. Could be a little more in each direction, but generally that's the range that you're going to find here. And finally, the last box is the real higher risk box. Motion in this box can go from plus 25% to minus 35%. So it's up to you and your advisor to know how you would like your funds dispersed through the risk curve. It's all up to you advising your advisor. So the true key to diversification is not just picking some mutual funds or stocks, but it's actually picking different asset classes. The goal is to have something that is going to go up when something else is going down. So asset classes, and this isn't the limit of it, include equities, stocks, mutual funds, ETFs, debt, that can be credit, bonds, real estate of various types, precious metals, which very, very small percentage of the population has any money in precious metals, and insurance products, fixed indexed annuities and life insurance. So let's take a look at how some things work. These are three mutual funds from a single mutual fund family. But you've probably heard the diversification advice of, well, you need to own some US stocks and some foreign stocks and some global stocks. So these three lines represent US, international, and global stocks inside of a mutual fund family. Was anything going up when the other ones were going down, or vice versa? Look how closely these three mimic each other, even though they're US, international, and global stocks. I wouldn't want to have all of my money in these kind of products. So let's look at adding a new asset class. We're going to put in a bond fund. And you'll notice there's not a lot of action in bond funds. They're mainly there for yield. This asset had a drawdown, that's the top to the bottom, we'll look at that on the chart again, of 13% versus 36% for the equity mutual funds. And as a little bonus, this particular bond fund also has a 6% yield. So let's see what happens when we put this on the chart as well. Well, suddenly we have some protection. Now, when I say peak to trough, if you look right above the D in the middle of the page, that's where the peak was for these funds. The actual loss of 37% is not from that peak. It's from the beginning of a year ago. This is a 1-year chart. But you see what happens when we put in the bond fund. It only went down 13% compared to 36% for the other holdings. We're going to add a new asset class. That's a precious metal. Let's see what happens here. You have 5 holdings now in the chart. The 3 mutual funds, the bond fund, and the precious metal. The 3 equity mutual funds are in a loss position. The bond fund is in a smaller loss position, but the precious metals are up 28%. Now we're really starting to get some diversity so that when something goes down, something else goes down less, and we might find something else that actually goes up. And that's what happened with the precious metal. I added one more item. Even though this is an equity, it's in a different sector. So this is a silver miner. And you can see that they're pretty volatile as the others, but the silver miner is up 125%, while the other items are down. Diversification. So just looking at this model, here's what happened. If you had a $60,000 portfolio and split that 3 ways into the 3 mutual funds, US, international, and global, then you're in a loss position down around 10% at this point. You'll see on the bottom, but your actual drawdown was $21,000, around 28%. Those three now being down 10% would be worth around $54,000. Let's see what happens when you diversify more than that. So now we're going to take 6 components of the portfolio and put 10,000 in each of them. The 3 equity mutual funds are down $3,000. The bond fund is in a loss position of $500. The precious metal is in a gain position of $2,800, and the minor is up $10,000. So in 1 year, the difference in value of poor diversification versus better diversification, and there's certainly more than this, is a difference of $54,000 and just under $70,000, which is a 27% difference in the value of your portfolio that you achieved by diversification. It's often been said, the best offense is a good defense. I love talking to new people and asking them, where's the defense in this portfolio? Most of them don't know where it is. Most of them don't really have defense. They're just playing mutual funds and individual stocks and ETFs. This is a company, again, I am not endorsing this. I want to show you this because it is an alternative to things that just go up. So look on the top line, and that's their results from this year. We all remember what happened in March. That's when your 3 mutual funds went down 36%. This group was up 11% in March. Now they do something, it's a little unusual. They trade volatility. That's all they're doing. There's no stocks in this group. But because of that, and volatility got very high, they had a good March, not a bad April. They're up 8% on the year when the S&P is down. This is another one of their strategies. Again, I am not endorsing this company or recommending that you should buy any of this. I just want to show you the defense. So look at March. They were up 19%, and also again in April and again in May. And year to date through May, they're up 32% where the S&P is down 5%. Just diversification, finding defense so that you don't move like everything else. So does your portfolio need a risk evaluation? Because you attended this, we will do one for you, and we use a particular tool that assigns your risk number to you. It goes through a short interview so you can establish a risk number. Then we'll go through your portfolio, and the portfolio and the holdings in it will have a number assigned to it. If you look right below the risk 46 sign, this software says there's a 95% probability over the next 6 months that you'll potentially lose 8.6%, and you can potentially gain 14.7%. It's a very effective tool, helps people understand how risky is this portfolio? Is that the risk level I like? Is it above or is it below? Because certainly some people may be taking less risk than they feel is necessary. This goes in and shows a scenario that what if the bull market happened again? The S&P will go up 32%. This will go up 18%. So we're trying not to have the extreme ups or downs that the market can hand us. We're trying to manage that risk through a combination. If the 2008 market were to occur again, the S&P went down 36%, this would only go down 20%. I don't like only go down 20, but when compared to 36, you're doing a good job. If some financial crisis were to happen, the S&P goes down 53%, this portfolio goes down 28%. You're seeing it's about half. And if interest rate spikes were to occur, this portfolio would go down 5% where the other one's up 5%. So it's pretty darn accurate, and it can really give you a good understanding of your portfolio. So what's next? If you would like to have a chat about this, and as I said, we will do this risk analysis for your portfolio at no cost or obligation. Schedule a time to speak with me. You can go to our website, www.assetpreservation.net, and there's a calendar item there, so you can just link a time to talk to me. Also, we have a newsletter. Contact us if you would like to receive that. You can certainly give me a call at 336-281-9990. Thank you for attending today. Hope to speak to you again soon.